Welcome, dear traders. Today, all eyes will be on the US inflation data. As a result, trading in the Asian Pacific region was muted. However, the drama of the yen potentially falling to 33-year lows is causing concern and tension. Markets are looking forward to the details of tomorrow's meeting between Joe Biden and Xi Jinping. Notably, the United States is China's most important trading partner, and the long-awaited talks between the two leaders could provide some positive clues in this regard. There will also be a lot of economic data coming out of China this week. For example, retail sales, unemployment rate, and industrial production data. Meanwhile, today's OPEC report indirectly confirmed the sustainability of China's economic recovery. It reads that China's oil imports remain stable and the profitability of refining oil products in Asia remains high. In addition, OPEC stated that market fundamentals remain strong and that the recent price decline was caused by speculators in the financial markets. And this report came out yesterday and dragged oil prices higher, which had already risen for the fourth consecutive session. In addition, as November 17 approaches, the risk of a government shutdown is increasing. This means that the US government could run out of money if politicians in Washington failed to reach a new agreement. Against this backdrop, US bond yields have been very volatile. For example, the 10-year Treasury note jumped to almost 4.7% on Monday and fell to 4.6% today. The US dollar declined range along with the US Treasury yields on the back of oil growth and a pause before the release of fresh economic data. During the Asian session, the greenback was flat at 105.60 and 105.70 and showed signs of a further decline. Despite the consolidation, the greenback continued to put pressure on its counterparts in the G6 basket. The US dollar index stabilized around 105.60 on Tuesday. If consumer inflation shows a slowdown in October, the Fed may consider halting its rate hike cycle. In addition, Chicago Fed President Austan Goolsbee repeated his view of getting the economy on the golden path, where US inflation should be brought to the 2% target without serious losses in the economy. Such prospects will increase pressure on the US currency, and the US dollar risks testing new support levels today. The Japanese yen seems to have avoided risks for some time. New verbal warnings from a Japanese finance minister, Shunichi Suzuki, followed on Tuesday. He repeated his usual statement about the undesirability of excessive volatility in the forex market. In addition, the policymaker warned that the government would take all possible steps if necessary. It's quite possible that the Japanese authorities did intervene in the foreign exchange market to prevent the national currency from falling to more than 30-year lows. Investors will unlikely get any confirmation from the Japanese politicians now. The intervention can be judged by the steep drop in the yen's quotes to 151.30. The dollar-yen pair reached this level yesterday during the European session, and today the Japanese currency fell again and traded at 151.60 in the Asian session. At the same time, the slight decline in the Japanese yen and its consolidation in the range of 151.50 and 151.80 can be explained by the weakness of the US dollar. While the greenback is taking a wait-and-see approach before the release of the economic data, the yen can take a small breather. At the beginning of Tuesday, the Aussie tried to recover in the area of 0.6390 on elevated oil prices consolidation of the US dollar and the positive news from China. However, bulls retreated and decided not to take risks before the release of the US inflation. Although futures on the US stock indexes are growing, the Aussie, which is usually sensitive to Wall Street sentiment, did not strengthen. During the Asian session, the Aussie was still in the bearish zone, remaining within the range of 0.6360 and 0.6386. The New Zealand dollar also went bearish during Tuesday's Asian session, breaking through support at 0.5870. The Kiwi has been showing weakness for more than a week, and the losing streak, which began on November 6, threatens to continue due to domestic data. Today's reports showed that New Zealand's food inflation rate dropped, and this means that the country's central bank may raise interest rates at its meeting on November 29. The New Zealand dollar is likely to continue to decline. As a result, the Kiwi dollar pair may go below the current range of 0.5864 and 0.6880. 5864 and 0.5889. And that's all for now. Stay tuned for more updates with the InstaForex TV channel. We appreciate your feedback. Please leave your questions and comments below, and see you online soon.